You're listening to Macro Sunday, hosted by Andreas Steno. Hi, everyone, and welcome back to the Macro Sunday podcast, your independent macro podcast out each and every Sunday. My name is Andreas Steno. I'm the founder and CEO of Steno Research. And as per usual, I am joined by my lieutenant, Emil Moller. Welcome, Emil.
Cheers, right from the countryside.
Yes, exactly.
Yeah.
The reason why we don't have you in the studio today, Emil, is that you're expecting your third child. Is that correct?
Yeah, third in 3 years. So yeah,
stop the count.
Keeping a streak. yeah. Oh yeah.
Well, good luck with that.
Christmas gets more expensive. Cheers. Yeah, we'll need it.
Indeed. And Emil, later in the show today, we're joined by an Austrian friend of ours, Ronnie Stoeferle, who's the author of the report called In Gold We Trust. So we're going to talk a bit about the shining pet rock today.
Ooh, terrific.
Yeah, terrific, yeah. And we recorded this interview with Ronnie on Thursday. And I think on Friday afternoon, the gold box received quite a bright, or rude awakening rather, after a strong non-farm payrolls report. Emil, the two of us have been banging the drums on a very strong data seasonality out of the US into year-end here.
Yeah.
If you look at the past week or two, do you think the actual evidence rhymes with what we've been saying here?
More or less. I mean, you can discuss the proportions of it, but I think it's quite clear that the U.S. economy has at least some more steam to it. And I think, the nail in the coffin on that hypothesis was essentially the non-farm payroll yesterday, which came in pretty strong. I would be surprised if we see some deterioration to that story before New Year's. So I'm optimistic short term, but it's brief from here. I fear.
Yeah, it probably is. But we got quite the counter move in dollar space and dollar interest rates as a consequence of this decently strong non-farm payrolls report, and it's a quite interesting backdrop ahead of that last FOMC meeting of the year on Wednesday. Emil, you wrote a piece on how to trade this FOMC meeting on Friday. So take us through your thoughts ahead of this meeting and what Jay Powell will say here.
So I think markets are caught a bit wrong-footed on this story, and I think some of the bond bulls will essentially end up getting burned. So at this juncture, I pretty much prefer being back in the steepener trade and long dollar. I think that's sort of the conundrum here, and the opportunity that's left risk reward wise here in December. So I think that whole thing will sort of reemerge as we approach year end. And I do think we could see some noise, if nothing else, in the sovereign space and the rest of the world, especially emerging markets. So I've also been banging the drum about re-steepening of sovereign curves in both frontier and emerging market space after a November full of relief. So it's it's nothing as good as it isn't bad to someone, I believe Leibniz said. So that's where we are.
Yeah, and I personally find it very interesting to see whether Jay Powell will acknowledge the feedback loop that he essentially almost inaugurated at the latest Federal Reserve meeting by saying that higher long-term bond yields would allow the Federal Reserve to lean back a little bit in terms of the future Fed funds path. And the question here is, if he acknowledges that feedback loop, obviously with lower long bond yields right, left, and center through November, it essentially means that he should sort of hawk up his rhetoric again in the short term. Right? He'll be given the chance to do that on Wednesday. If anything, I consider Bank of Canada the best leading indicator of the Federal Reserve, and they decided to very clearly hold the line last week by writing that the hawkish bias is intact. We do not acknowledge the risk of rate cuts and all of that. I think the Fed will do the same, but it remains to be seen, Emil. We we also see the repercussions for the gold trade. The gold trade has performed tremendously well through October and November, both on geopolitics, I think, but also due to lower interest rates in dollar space. Emil, you've been arguing that the gold trade could be running on fumes. Please try and take us through why you think so.
So I think, as most economists, we're sort of left in a bit of a I'm encouraged to say despair, because usually we would not. I mean, real rates at these levels shouldn't really rhyme with strong gold momentum. Yet entire 2023 has been pretty strong for gold, and I think we're approaching a stage where that buyers are exhausted. I think what could really turn it around is essentially just geopolitics and central banks keeping the market momentum up on their behalf. But I think the appetite is running on fumes. And I would also argue, if we get embedded expectations of longer real rates really priced in, you will see some flows out of gold and into bonds once more, and I expect that to be the next step here. So I'm not too optimistic on gold, I fear, short term.
Emil, as per usual, we have a soundbite with Donald Trump in this show, and of course, Mr. Trump also has an opinion on the shining pet rock gold. I'm not sure he was particularly vocal around gold while he was in office, but before taking office, Donald Trump was, I guess, one of the main proponents of gold as an equivalent to cash. So here's a, I guess, roughly 10 years old soundbite with Mr. Trump. And he is, at least at the time, very, very positive on the say outlook for gold and gold used as security deposits. So here is Donald Trump.
Donald Trump says gold is better than cold, hard cash. Donald Trump is renting out the 50th floor of 40 Wall Street for 10 years to APMEX, American Precious Metals Exchange, and accepting 3 32-ounce gold bars as a security deposit.
Well, sadly, we all know what's happening to the dollar. The dollar is going down, and it's not a pretty picture, and it's not being sustained by proper policy and proper thinking. This was an opportunity, and maybe an opportunity to show people what's happening with the dollar so that we can do something about it.
Michael Haynes, CEO of APMEX, is the mastermind who hatched this plan.
To us, cash, gold, they're basically the same asset. As we were negotiating this, we went to Mr. Trump, who I think is a very smart guy, and we presented him with some data, and you just heard him speak and say, it didn't take me very long to say, yes, I want the gold instead of the cash.
Are you trying to line up any more deals like this?
Well, as
personal or professional?
Well, as we continue to expand our footprint here in New York, we're planning on taking some more space, hopefully, as our business continues to grow and we expand around the globe. And as we take on more obligations there, perhaps we'll be required to give more gold as a security deposit.
Mr. Trump is also ready to keep doing business in gold.
I never thought this would happen. This is the first time it's actually happened, and maybe it's going to set a trend.
A trend that would turn gold from just a safe haven investment and into a viable business alternative to the U.S. dollar.
Oh, Emil, you gotta love Donald Trump, and I mean, I think this view resonates with quite a few people in the U.S. That gold is sort of the ultimate store of value. So where are you on that topic?
Oh, sure. Listen, if you have a long beta portfolio and you don't have any funds allocated to gold, you're an idiot.
Yeah, I agree.
So I'm not against gold at all, and I do think, I'm not entirely sure on this, but I could imagine that if you construct your position the right way, I think you have some leeway tax wise. I should give no no recommendations on that score, but I used to work for an American, so I know I know there are a few loopholes on that score. But really, I think who really drives gold besides markets are essentially the buyers. And I think central banks have been spooked by American sanctions and utilization of US financial power. That's why we've seen so much momentum in gold these past quarters. I think that's running on fumes, and I don't really buy into that whole dollar doom story. It's idiotic, essentially. Everything is tied to the dollar, debt, assets, everything. So, you should buy gold if you don't have any, but I don't think tactically it's the right entry point right here. That's how I look at it.
A piece of advice straight from Cayman Islands with Emil
Yeah,
Møller.
yeah.
Emil, why don't we bring a true gold expert on the floor? Not to say that you're not a true gold expert, but at least you're more of a macro generalist than than a precious metals guy. And our friend Ronnie Stoeferle is the author of the In Gold We Trust report. He runs gold funds in the company called Incrementum. So he's obviously on top of both the supply and the demand side in precious metal space. Ronnie is an old friend of mine, Austrian, by the way. And when I chatted to him before the show, he said to me, if you want to make a nice introduction for me, here's one soundbite that you can choose, but if you want to ridicule me, please play a soundbite with DJ Ötzi. So I obviously decided on the latter. So to introduce Ronnie Stoeferle to the Macro Sunday podcast, here's DJ Ötzi with a song called Hey Baby.
Okay, senoritas and caballeros, and ladies and gentlemen, meine Damen und Herren, hey baby from the 17th. Okay, put your hands up in the air, die Hände in die Höhe, und everybody sing now. Hey, hey baby, I wanna know if you'll be my girl.
It is now my great pleasure to introduce Ronald Stoeferle to the Macro Sunday podcast. Not only a great financial analyst and a great macro pundit, but also a friend of the show. I'd say, Ronnie, it's great to see you. Thank you for joining us.
Thanks, Andreas. It's a pleasure. I told you, I think I'm playing Sunday night football for more than 30 years with my friends, and every time I drive to this old guys football session, I listen to the Macro Sunday podcast. So it's a great pleasure, and congrats on everything that you're doing. I really enjoy studying your stuff.
Now you get the opportunity to listen to yourself while you're driving.
I hate that.
This week, right? But Ronnie, you're the managing director of Incrementum Funds, and you have a strong interest in the gold market. And I'd like to spend most of the time today discussing gold and Bitcoin in light of the great moves that we've seen over the past couple of months. I had the opportunity to interview you, I think actually exactly 2.5 months ago, just before this great rally started in gold and Bitcoin. So looking at the past couple of months here, what's going on in gold space, Ronnie?
It's a good question.
Yeah.
Actually, when we had this conversation on, I think it was Real Vision with Frank Justra, I thought the sentiment was really, really negative. Yeah. So I just attended a couple of mining conferences, and it felt like attending a funeral. It was like really, really bad. Now I would say sentiment has gotten significantly better. It is not euphoric yet, but definitely slightly more optimistic. So what happened? Obviously, I think it's all a big macro trade, and we've seen this big reversal in yields, especially in the 10 years. I think that the market is kind of discounting now between 4 to 5 rate cuts for next year. I think that the price of gold is sending a strong message, and the message is recession ahead. And I think there's many indicators that you probably know much better than I do. But I think just have a look at the various subsectors in the commodity space. Have a look at the gold silver ratio. I think they're all telling us that the economy is not doing so well, and we crunched the numbers in our previous In Gold We Trust reports and found out that gold is actually a pretty decent recession hedge, and it's also some sort of a good forecaster of a future recession. So I think that's the main topic the main reason that we are seeing for this move in gold.
So I'll allow you to elaborate a little bit on that study on gold through recessions. How solid a recession hedge is it, and why do you think it is?
Well, I think so we analyzed every recession since the year 1971, which was basically let's say the IPO of the gold price, and on average, gold is up 10.6% during those 8 recessions since the year 1971. So in 6 out of those 8, gold rallied sharply ahead of and into the recession. And I think during the recession, especially at the later stages of a recession, that's most of the time, when central bankers and politicians really hit the panic button. That's the time when economic news couldn't be any worse, when everybody is forecasting a depression. That's probably the time to get a little bit more aggressive on other assets like commodities, like silver, also on equities, obviously, because usually that's the time when central bankers radically reduce interest rates. That's the time when fiscal stimulus is announced, and I think that the price of gold is kind of sniffing that out. So that's probably the main reason. From my point of view, if we have a look at this year, I have to tell you we've been completely wrong on forecasting that recession. We went from hard landing to soft landing to no landing. Now it is kind of Goldilocks scenario in markets. But I still think that those indicators that we follow, like the leading economic indicator now being 19 months in a row down. Then, of course, the yield curve, but we can also see it in labor markets more and more, that the U.S. economy is not doing so well anymore. And I don't know what's going on. Where are you currently in Copenhagen? Yeah. The Danish I know are the luckiest and the happiest people. It seems, according to some surveys. But I've been visiting clients in Germany last week, and I can tell you that the sentiment couldn't be any worse. Everybody is really pessimistic, really grumpy, and they even lost 2-0 against Austria in football recently. So they're having a tough time. China is obviously not doing so well. So I think the U.S. economy has really been the last man standing, and I think it's going to stumble.
So, Ronnie, when we look at gold and Bitcoin, for that matter, over the past couple of months, both gold and Bitcoin have rallied alongside tremendous performance in technology stocks, tremendous performance in bonds. It's been tricky to find something going down in price outside of energy, maybe, over the past 8 weeks. So how do you view gold from a correlation perspective here? Because obviously gold is typically used as a diversifier in portfolios. But do you think it's an issue for the gold price that it rallies alongside everything else here?
Yeah, that's a great question. I mean, it seems to be really one trade at the moment. And when it comes to gold and Bitcoin, we've actually got 2 funds that combine the old Petrock and the digital magic beans, as it's sometimes called. And I think it makes sense, because gold and Bitcoin actually over the long term do not have any correlation at all. So combining both of them, both, let's say, monetary technologies from our point of view, makes sense. Now, Bitcoin over the last couple of years behaved more like a risk-on asset. However, I thought it was interesting during the the SVB crisis in spring, and it feels like ages ago now, at the end of the year. But yeah, just 9 months ago, there were a couple of days when Bitcoin kind of acted like a risk-off asset. I thought it was really interesting to follow. Now, going forward, I think that let's take a step back, Andreas. I think it's important to say that there are many doomsday sayers, many really, really miserable, pessimistic people out there, especially in the gold camp. From my point of view, gold is not the solution to all our problems. It's not the answer to all the questions, but it makes sense in certain scenarios. And we crunched the numbers and wrote like a gazillion pages of research about those topics. Gold works as a recession hedge. Gold usually works in times of deeply negative real rates, in times of falling real rates. And this is also pretty interesting that we're seeing exactly the opposite, and gold still holding up so well. Gold works pretty well as a dollar hedge. And it works really well as an equity hedge. So those are, I would say, that the main functions of gold. While Bitcoin, is basically just a teenager, and the whole ecosystem is growing up, it's developing, and it's for me, it's really it's interesting to see how this monetary technology evolves. I think the triggers at the moment are obviously the ETFs that at some point will probably be allowed. And the second one is the halving, which is also usually a very, very good setup for the price of Bitcoin. But therefore, I think it's the fact that gold and Bitcoin rising at the same time. That's a very interesting sign, and it's also probably a sign that I don't know. Probably the market is kind of already discounting future rate cuts, perhaps more inflation volatility, falling real rates. So those messages, I think, are sent by gold and Bitcoin at the moment.
So, Ronnie, when we look at this rally in gold, say over the past 8 weeks, but also the tremendous stability in gold despite higher real rates, which is kind of an anomaly if you look at it historically, at least. Who's behind all of the buying here? Is it very central bank driven, or is it driven by other institutions? What's your gauge here of the buying sentiment in gold space? Who's behind it?
That's really the big question, and the thing is, the market is here trading slightly below all-time highs in US dollar terms, without any significant ETF buying. So ETFs are still muted and are still kind of light sellers. And I think going forward, that could also be a big driver for the price of gold. Now, who is buying? And it's central banks. We've seen an all-time high in central bank buying last year, more than 1,100 tons. This year, up to the end of the third quarter, it was slightly more than 800 tons. So we could say that probably central banks and sovereign buying has kind of put a floor under gold prices, yeah, and we tend to criticize central bankers, but when it comes to gold, they're long-term strategic buyers. They're to some degree bureaucratic organizations. So therefore, I think that they're really in for the longer game. And who is actually buying? I mean, it's China just purchased 180 tons. Year to date, they're up 600 tons. Then we're seeing obviously Turkey buying. Poland has significantly increased its position, but it's also Singapore, for example. So it is primarily, I would say, central banks from emerging markets, from Asia. And I think that if we wouldn't have seen that enormous amount of central bank buying without significant investor demand, I think actually the price of gold would be significantly lower. So That's probably the main answer. So I think going forward, once we hit new all-time highs, and once we go really on a sustained basis above the old all-time highs, I think that ETFs will really become one of the main drivers. And over here, I can tell you that there's a couple of journalists that called me, but I don't see anything like a gold mania over here. At some point, probably it's going to happen, and as we know, there's no fever like gold fever.
That's indeed true, Ronnie. Um, I I remember the latest gold spike when all big bond curves were trading in negative yield territory. That was much more driven by retail. It seemed like, at least. While you're absolutely right, it's quite striking to see the data on central bank purchases, and even Poland, as you mentioned. I think that's a very great example, because why should Poland necessarily fear the ramifications that the Russian central bank was met with? But still, the Polish central bank is buying. So, Ronnie, it leads me to a question on allocations to gold in portfolios, both from households but also from larger institutions. Um, I've seen some data in the US on like the average holding of gold in a household portfolio, but what's your sense of the geographical differences here? How normal is it to hold gold in a portfolio in Europe, in Asia, and the US? Are there large differences between the regions?
Well, for the US, there was a survey by Bank of America, and it said that 71% of all investment advisors have 0 to 1% exposure to gold. 27% have 1 to 5% exposure to gold. So actually, it's clearly not a crowded trade in the United States. And I'm often talking about the monetary DNA, and I think that US investors and Americans in general are still heavily influenced by the stories of the Great Depression, and they fear deflation. While over here in Europe, especially in German-speaking Europe, I think we still feel, the all the stories from hyperinflation and currency
Mm,
reforms, and I think this is one explanation for the significantly higher affinity for gold especially in Germany and in Austria compared to United States. When it comes to European investors, institutional players, I would say it's definitely not a topic. As I've said before, ETF investor demand is probably some sort of a marginal demand that will kick in at some point. If we compare the last big gold market up until the top in 2011, we saw major inflows into the ETFs, while over the last couple of quarters we saw significant outflows. So that could really make a difference. Germany actually, German investors were heavily selling this year. Also, Austria is not doing so well in terms of a gold demand, probably because of the opportunity costs. Now you're really getting slightly positive real rates on your savings account. So that's clearly big opportunity costs for owning gold. But what is really most interesting, Andreas, is what I sense when I travel to Asia. 2 weeks ago, I was in Dubai, and I did a keynote there and held a seminar for the Dubai Gold Exchange. I talked to traders, to investors, to um, gold refineries from Turkey, from India, from China, from Russia, and it's really staggering to see how much more important gold is for those
mm,
countries. And gold always goes where the money is, yeah, and where money is well treated and where growth is. So it went to the United States between the two world wars, and actually the Americans had roughly 30,000 tons of gold back then. After the Second World War, Deutsches Wirtschaftswunder, it went to Europe,
mm,
and now it's clearly moving to Asia. And so,
mm.
therefore, I think we've written quite a lot about the gold flows to Asia. Just China and India used to be responsible for 28% of global gold consumer demand. Now it's more than 50%. So I think we here in the Western world, we shouldn't be too arrogant and think that we're the center of the gold world, because we're clearly not anymore. And it's central banks in Asia, it's consumers that are really significant bias. But it's also on the production side, where China is by far the largest producer, Russia is the second biggest producers. So it's also on the production side where emerging markets really dominate the gold market.
Mm. And speaking of the production side of things, Ronnie, one thing that strikes me, I'm more of a commodity generalist. I don't necessarily spend too much time on assessing precious metals from a supply to demand dynamics perspective, but I rarely hear stories around the supply side of gold. So, I mean, how important is the supply side relative to the discussion we have on the demand side here?
Um, the thing that really differentiates gold from commodities is the high stock to flow ratio. So the stock of gold is more than 200,000 tons of gold, because gold obviously is not being consumed. It's just being hoarded. While the annual supply is roughly 3,000 tons, and that's fairly stable. So on average, over the last 100 years, we had an average inflation of 1.7%. So that's actually, the amount of new gold that comes into the market. Now, our take is, and that's, I think that especially in the gold space, many people don't really understand the significance of the stock to flow ratio. Our view is that we should not talk about yearly supply demand too much, because actually every day there's gold being traded. I think 140 billion US dollars. Obviously, the majority is paper gold. Yeah, we know that, but it is an extremely liquid asset class. Now, people tend to forget that the gold that is still around, that's obviously part of the supply. So once the price of gold spikes, it's, for example, Indian housewives that start selling their gold. So recycling supply really picks up significantly, and this kind of smoothes price action. And this is really the big difference compared to commodities, where the stock relative to the flow is significantly lower. So from my point of view, and this is really our take, gold is very much of a macro investment. So in our reports, we talk about the annual supply and the demand, but we talk much more about opportunity costs, about interest rates, about where is inflation heading. All those topics are, from my point of view, from an analytical point of view, more important than just crunching the supply demand data, like for a normal commodity with a very low stock to flow ratio.
Makes a lot of sense. And Ronnie, it leads me to the billion-dollar question here when it relates to gold into 2024. When you look at forward curves for dollar interest rates, euro interest rates, sterling interest rates, you name it, a lot of cuts are now priced into next year. I even think that we're pricing in more than 5 now for the European Central Bank in 2024. What's your sentiment here? Is it feasible to expect such a cutting cycle next year? And does it rhyme with your recession call?
Well, I think that there was when was Jay Powell? It was, I think, like last Friday, and I thought that was kind of a hawkish statement when he said it would be premature to conclude with confidence that we have achieved a restrictive stance. But then actually the market, the interpretation was extremely dovish. Yeah, we've seen it in the gold price, in Bitcoin, in yields, in equity markets, and Andreas, we know that monetary policy is 98% talk and 2% action. That's, I think Bernanke said that. So I think that Jay Powell isn't happy at all with how the market regards the future central bank action. So I think he will try to sound more and more hawkish, and it's all about the credibility that they have kind of regained over the last couple of months. Nobody, I mean, I wouldn't have expected that, and I don't know too many strategists out there that would have expected that interest rates will rise more than 500 basis points, and markets would still be doing kind of okay, and U.S. economy on full employment. I have to say, I didn't expect that. So credit to Mr. Powell. And always referring to Paul Volcker with his keeping at it a phrase and this narrative that he created. I think he doesn't enjoy the fact that the market now says, okay, we're going back to the old paradigm, and recession is coming, and the Fed will cut aggressively and probably at some point stop with quantitative tightening. So my take would be that he will try to appear more hawkish going forward. But what we shouldn't forget is, we've got the elections coming up of the two young, hungry upstarts, Joe Biden and Donald Trump. We all look forward. It's gonna be really, really dirty, I think. I think I listened to The Rock on the Joe Rogan show, and The Rock, the former wrestler and now action hero, he said that he was actually asked if he wants to run for president. So this already tells you quite a lot about U.S. politics. But my take would be that usually the Federal Reserve is having some sort of a dovish tilt in an election year, and I think that the Federal Reserve is definitely not political, but I'm not 100% sure if they really want to see Donald Trump winning, because he's anti-establishment. So therefore, that would be another reason why I think that over the next year they will be rather on the dovish side. But for the time being, I think Powell is really mad at markets now, so he'll probably try to at least appear more hawkish, and will try to talk markets down a bit.
And Ronnie, since you're German speaking, you're Austrian as far as I remember,
big
right?
Difference.
I have yes, big difference. But I have to ask you about both the European monetary policy, but also fiscal policy in light of this discussion on the dollar side of the equation. I actually read, I think it was a couple of days ago, in the Bild-Zeitung, a CDU politician suggesting that the Germans could use the gold holdings to fund these new electricity aid bills. I don't know whether you read that story, but how do you assess the German speaking part of the world and their stance on monetary policy and fiscal policy into next year? Because that's also interesting.
There's always this big rivalry between the big brother and the small brother. Canada, US, Australia, New Zealand, and also Germany, Austria. So as I've said, we won against them for the second time in a row in football, and it also seems that the general sentiment in Germany is much, much worse compared to Austria and compared to other European countries. And most of the people that I talk to, and they're obviously mostly from the finance space. So they're really, really mad at German politics. I think at some point it will be impossible to completely ignore the AfD. Because you just can't say that 30% of all voters are actually far right wing, radical people. So that's it's gonna get interesting. I think we've got in 3 states we've got elections in Germany next year. I think this story that came out in Bild-Zeitung, it created a huge amount of backlash. But then on the other hand, I think it was also interesting that there was a German comedian, Mr. Böhmermann, who is not funny at all, and he put out one of his shows where he basically said that everybody buying physical gold is a Nazi, which is, a very powerful narrative, and I think this is really something that the Germans are dealing now with. Germany is in a big mess at the moment, but I think we've probably seen peak pessimism. Germany will bounce back, as they always do. So and therefore, I think with the ECB, we know that the ECB basically always follows the Federal Reserve. So probably they're gonna lower rates next year as well. What I just can tell you, there's in the real estate space. There was a huge bankruptcy, and it was kind of an Austrian story. Mr. Benko, the poster child of the positive effects of zero interest rates and an enormous amount of leverage. Of course, this business model that worked at zero rates doesn't work anymore at 4.5%. So the company is going bust now, and this is just a sign that I think large parts of the world, actually, it's not only Europe, are just not able anymore to really deal with this amount of interest, or this level of interest rates, and especially if it would have happened really gradually, but it was really such a fast move on the rate side. It was like really hitting the brakes when you're going like 180 on the autobahn, then really a full brake that has consequences, obviously, and we're now really starting to feel them.
Yeah. Ronnie Stoeferle, it was a great pleasure hosting you here at the Macro Sunday podcast. If our audience wants to find out more about for example, the In Gold We Trust report, where can they find out more about
you? Well, we publish the In Gold We Trust report every year in May, roughly 400 pages. So it's a long read. But there's also a compact version. It's available totally for free on our webpage, ingoldwetrust.report. We're putting out monthly chart books, the Gold Compass. We're putting out special reports like ski tickets measured in gold, for example, beer at the Munich Oktoberfest measured in gold, short story, measured in gold. Prices are fairly stable, so it's not prices rising, but rather the purchasing power of fiat money falling. And then for our funds, we manage 6 investment funds. We're a boutique based in Liechtenstein. Have a look at our webpage, incrementum.li.
Ronnie Stoeferle, it was a true pleasure to host you. Thank you very much for being with us.
Andreas, thank you very much. And thank you for being my friend every Sunday night, going to my old guys' soccer game. Thank you, Andreas.
Let's see whether you're there listening to yourself this Sunday.
No, I won't.
Take care.
Thank you very much. Bye-bye.
Back after the interview with the great Ronnie Stoeferle, author of In Gold We Trust and managing director at Incrementum Funds. Funny thing was that Ronnie actually noted a week ago that we talked about the Austrian 100 Jahre Zinsderivaten, or in plain English, the 100-year Austrian bond. And we made a truckload of money implicitly on that trade through the month of November. Actually, Emil, I find it quite intriguing that bonds, to a large extent, outperformed equities through this rally in both equities and bonds through the latter parts of November. I think we booked almost a 14% profit in this euro duration bet, including the 100-year Austrian bond. So where are you on euro duration bets right now? Is it fair to assume that there's a pause in the performance here, or how do you see this playing out?
So that's the flip side of my US dollar bond bearishness. Essentially, what drives yields here is Washington and the US. So if you have an upgoing pressure on US yields, eventually it will spill over to the rest of the international bond market. So yes, I think we will see a temporary yield momentum reemerge. But if you look at it, say into Q1, I don't think we've seen the bottom in euro yields at all.
No.
And I think the fragility is really getting momentum within the eurozone. I mean, we've been spot on about euro inflation, right? And I think that has another leg to it. And if energy prices remain compressed, I think it could really gather some steam. So I think I'm bullish come Q1. Probably a bit on the sideline for now. That's how I look at it.
Fair enough, Emil. And speaking of euro inflation, I think we were the only research house on Earth with a correct assumption on the euro inflation number in November. We have quite a few inflation prints upcoming in the week ahead of us. Norway, Sweden, out of Europe. To take a few examples, we have the US inflation report less than 24 hours ahead of the FOMC meeting. Yeah. We have the UK inflation report coming up in around 10 days from now. And I think the overall picture is the following. European inflation wanes much faster than what is the case in the US. I even see a strong case for a mild rebound in US inflation. We're talking short term here. Various live gauges of inflation support that notion as well. When we try to web scrape for price trends through the month of November, we also get a clearer picture, especially in the UK, on discounts through Black Month. So again here, sounds like a positive dollar story, doesn't it? With firmer trends inflation-wise in the US compared to European peers. And what I wanted to add here, Emil, is that when we look at the European Central Bank, and I'd like your take on this as well, we've been all over the story that Italy is weakening fast beneath the surface. It's not really something that has caught the headlines yet. But if you look at M1 contributions from Italy, it's through the floor, basically. So basically the money creation in Italy is down a lot. If you look at rejection rates in Italy on lending, it is through the roof, and so on and so forth. But yet there is, it seems, a bit of optimism in Frankfurt around trying to taper off holdings in the pandemic purchase program. And that is essentially the program that has kept the Italian bond market afloat, if you ask me. So ahead of this ECB meeting, also here in 5 days or whatever it is, what's your view on Frankfurt?
So I think they will basically do, to quote a certain banker, whatever it takes to keep the Italian debt situation afloat and in control. I think we still need to see some more blood on the Italian side before we really start to contemplate with fragility. If you look at retail sales, it wasn't that atrocious. Italian consumers are still spending money despite not having access to credit to the same extent as they used to. So I think we're still in the early innings here, but yes, that whole thing could definitely start to push up again. But it's a bit of an interesting juncture here in Europe, because on one side you see some reversal in manufacturing if you look at what basically has been the most stressed, and that goes from basically German energy intensive industry to other manufacturing gauges. If you look at orders versus inventory, there's actually a bit of a reemergence in that trend. But on the other hand, services starting to look a bit weak, and I think labor market are slowly but surely giving in. If you look at French GDP, that was quite worrying. That's a big country in the Eurozone, with Germany already in the mud. We're in trouble here. And then you have a problem on the import side of financial momentum from the US, right? So it's an interesting juncture. And you wrote this piece on US liquidity. I thought that people should perhaps pay a bit of attention to what's going on in the repo facility. Perhaps you can enlighten us a bit on that one.
Yeah, so I mean, in sharp contrast to the liquidity picture in euros, the liquidity picture is actually improving in dollars due to technicalities, but it still sort of works to keep everything afloat in dollar markets. The overnight reverse repo facility is slowly but surely being depleted, and slowly is probably mild underappreciation of the trend here. We're talking about a depletion pace of 300 billion a month on a trend basis ish, driven by continued large T-bill issuance. So basically, when Janet Yellen issues a new T-bill, the money market fund with money parked at the overnight repo facility, pulls out the money from the reverse repo and buys the T-bill, and thereby a deposit is created in the banking system unless, and let me stress the word unless, Janet Yellen builds up the capital buffer at the TGA, the Treasury General Account. But for now, the net effect here is that dollar liquidity, or the amount of dollar reserves available to the private banking system, is those trends are on the up, and it probably will continue at least until mid-February or early March, where we will get close to a complete depletion of the overnight reverse repo facility. I'd even argue that we saw some early stress in the SOFR versus Fed funds spread early last week, and I'd argue that the funding stress seen there will basically incentivize funds to pull out money from the overnight reverse repo facility even faster. So we probably have a big liquidity push coming up here in the next 4 to 6 weeks. So it's probably not the worst idea in the world to be long some risky stuff in dollars. Talking about tech here, talking about Bitcoin, stuff like that. It's not the worst idea in the world, and I have some sympathy for that view short term. But there's a rude awakening on the other side of the depletion of this reverse repo facility by, say, early March or thereabout next year at the latest. Emil, having said that, we've basically taken the victory laps on on the good scores of our portfolio here. Euro duration performing like crazy. We've had a strong call on the dollar. It has performed as well. But we have a flip side of all of this that we haven't discussed yet. The energy space. And just to disclaim it up front, I mean, energy bets typically work as a counterweight to other bets in the portfolio. And we've had strong performance in other parts of the portfolio, but weak performance in energy space. But there is one interesting discussion supply-wise that I kind of find underappreciated in markets right now, and that is the whole risk surrounding the oil supply out of Venezuela and Guyana. Emil, you're, if not born and raised in LATAM, then you've at least spent years after years in LATAM before we signed you here at Steno Research, among other things in Mexico and Brazil. And Brazil obviously borders both Venezuela and Guyana. So take us through your thoughts on this oil dispute between Venezuela and Guyana. Is it something that we should worry about?
We should. I think what a general geopolitical trend we've seen here since the Russian invasion and everything going on in Central Asia and Gaza, not to mention, is that I think we have some embedded expectations in US being restraining themselves from engaging in conflict, and that sort of leaves some room for bad actors to do their bidding. And I think that's essentially what we're starting to see in Venezuela, who obviously are desperate and in financial dire straits, and it's a catastrophe basically, and it's been for years. Large groups of migrants leaving the country, the economy, and we shouldn't even talk about the currency, which is that's a story on its own. Meanwhile, the neighbor Guyana has massive oil reserves and are building up production. And after Maduro having making some progress on the political side by avoiding and easing some of the sanctions pressure imposed by the US due to the supply situation in general, they've decided to, if nothing else, at least see what will happen if we start to threaten Guyana a bit here. Question is whether they really have the minerals to do so. We see Brazilian military now engaged on the border. We see U.S. operations in the sea just north of Guyana and Venezuela right now to send a signal. So that's a bit of a risk scenario right here, and I think that really carries out into the Middle East as well when we look at the supply side. But I think, and I've said this before, right? I think coming into 2024, I think there are more upside risk on the supply side than downside risk. But there are some pockets of concern, both in the Middle East and Venezuela and Guyana here at this point. So.
And to add flavor to the list of involved countries here, as far as I'm concerned, Guyana is at least partially of almost Indian heritage, if you know what I mean. I think a bit more than 1/3 of the population holds Indian heritage, and India is heavily involved in this conflict, at least behind the scenes as well, on Guyana's side here. So loads of geopolitical consequences potentially from this conflict. But for now, I probably agree with you that supply side risks are rather tilted to the upside than the downside. And we've barely kept ourselves alive in this oil trade amidst weakness in energy space. But I think the best case for oil here is that Joe Biden decides to turn on his inner trader again and fill up the SPR soon.
And why wouldn't you at these levels? I mean, if you really want to avoid political pressure and you want to carry some momentum into the election, why wouldn't you try to fill up the SPR and see if you can establish a bottom in gasoline prices for the electorate? I think that's basically the playbook here, and I think it's the quote unquote easiest side for Biden to really do something. I think expanding expenditures from public coffers is increasingly getting difficult due to the political gridlock. So I think that's an obvious cause, and now he has Blinken doing all his dirty work for him. But we will see. We'll see. It's going to be interesting.
Yeah, and there's a window of opportunity for him to build up some ammunition ahead of the election here. Should Mohammed bin Salman again try to should he try to bring down the supply ahead of that election date, which I find likely still. So let's see, Emil. Once again, a great pleasure to talk to you here at the Macro Sunday podcast. We'll see whether you've become the father of 3 kids in a week from now. Else we'll send live from the bunker at Cayman Islands next week.
Oh, will do. We'll see to it.
Yes, and Emil, we've actually forgotten about it today, but we probably better play our disclaimer, the best disclaimer in the world, if you ask me. So now that we've discussed a few trade ideas here, Emil, here is Gerardo Gattuso with the disclaimer of the Macro Sunday.
Sometimes may be good, sometimes may be shit.
Obviously referring to our trade ideas in the show. A pleasure hosting the Macro Sunday again this Sunday. Next week, we will be back with a friend of mine, but also a great storyteller when it comes to the exponential age. We had Kathy Woods last week, and next week we will host Raoul Pal for a discussion on how the exponential age thesis fares amidst all of this turbulence in geopolitics and amidst all of the turbulence growth-wise. So stay tuned for that next week. Thank you very much for watching or listening to the Macro Sunday podcast this week. I'm Andreas Steno from Steno Research. If you want to check out our offering, we'll leave the link to the Steno Research portal in the show notes. See you again next week.